65 million in profit a year, 25 acquisition last year, and 0 outside investors. I've been analyzing this Norwegian company called Hulk Infinity. And their approach is exactly what I'm doing and implementing at Global Digital Group. They went from one acquisition to over 65 million in profit in 8 years. And to be clear, this isn't some VC-backed startup that raises a bunch of money to grow. Let me show you exactly how they did it. In 2016, a couple from Norway, Johan Michelsen and his wife, buy their first company, Jota, which is a cloud storage business in Norway. It's nothing revolutionary, it's just a profitable software business with recurring revenue. But instead of just trying to grow that one business, they use its cash flow to fund their first and next acquisition. Then they use both companies' cash flow to buy a third one. By 2024, they are doing over 25 deals a year. They have over 65 million in EBITDA across their portfolio, which in simple terms means profit, and they've still own more than 30% of everything, which means around 9-figure net worth on paper. Before you think, I don't have money to buy my first company, if you already built a profitable business, you are actually ahead of where they started. So that first acquisition I mentioned, cloud storage business, basically means having a business with predictable monthly revenue, high margins, and customers that rarely leave. Those software businesses are great, but this can be done in almost any industry, including services as we do. They targeted a fragmented market. Thousands of small software companies exist in most countries, with no dominant player in most verticals, which is perfect for consolidation. Here's the math that matters. I don't have the exact numbers that the first business they acquired generated in revenue and profit, but it seems like Jota was around 800k in profit. For this example, we can assume it was around $1 million in profit. Doubling or tripling that organically can take a few years. Depends how good you are, but typically takes a few years. So instead, what they did, they used that profit to buy another 800k profit business, which means doubling in one transaction. Now, if you've got over $1 million in annual cash flow the next year for acquisitions, then in the next year you have 4 million, then 8 million if you compound. The company accelerates quite fast. By 2020, the founder brought in a CEO and built a deal team. This team doesn't run a business, they just find and execute deals. They are created standardized due diligence, processes, repeatable valuation models, and systematic deal sourcing. This is how you scale from 1 to 2 deals per year to 25. Now, to execute the deals faster and target larger deals, by 2024, they've raised over 200 million in bonds. At 65 million profit, it's roughly 3 times their profit. Now, quick explanation, bonds are basically loans. So instead of going to bank for 200 million, you go to multiple investors and say, for example, lend us money. We will pay you X% interest rate every year for, let's say, 5-7 years or whatever it is, and then pay it all back. It's like getting a mortgage for your business. The investors get steady interest payments and Hawk get cash to buy more companies. And here's the key, they don't give up any ownership of this holdco. The founders still own 30% of everything. It's different from raising venture capital where you sell pieces of your company. With bonds, you keep full control, just pay interest like any other business expense. But again, you need to understand debt and how it works in order to do this. Also, what's different about Hawk is that they don't come and slash costs in the business. They keep founders involved, let businesses run independently, and they are getting around 22% organic growth on top of acquisitions. Founders actually want to sell to them, which means better deal flow. If you're already doing 1 to 5 million in profit, you are in a better position than Hawk was when they started. You already have the cash flowing asset. In my other video on my channel, I talked about 3 stages of building wealth as a founder. Stage 1 is building a cash flow business. Stage 2 is turning it into an asset that runs without you. And stage 3 is thinking like an investor and building a portfolio. Most founders get stuck between stage 1 and 2. They've got the cash flow, but they are still the bottleneck. If that's you, you've got 2 options. Option 1, get your business running without you first. Build the systems, hire a team, and become a true CEO. Then use it as your acquisition platform. That's what we are doing at Global Digital Group. Option 2, start acquiring while you are building your systems. Buy complementary businesses that already have good operators. Let them run while you build the holding company structure above. Either way, stop thinking about growing one business and start thinking about building a portfolio. Your existing business isn't the end goal, it's the platform for something bigger. If you have any questions or need help with that, you can check the link in the description. Or go to globaldigital.group, which is our company which we are listing public to execute this model. We can partner if it makes sense. So back to Hulk Infinity. If you look at the progression, in 2016, they buy Jota. In February 2022, they are at around $18 million in revenue. By February 2025, they hit $207 million in revenue. Around 65 million of that is in EBITDA profit. The numbers I had were in Norwegian currency, which I was converting to actual dollars, which I'm basically talking in right now. So keep in mind the conversion rate might a little bit fluctuate. But anyway, that's over 10 times revenue growth in just 3 years through systematic acquisition. And it's way faster than if they try to grow just one company. Most people don't realize that billionaires grow this way, or most larger companies grow this way. But they are still trying to push more marketing and sell, which at certain scale has diminishing returns. With acquisitions, the model creates value automatically. If you buy smaller businesses at 3 to 5 times their profit, once they are part of a larger group, the portfolio can trade at 10 to 15 times profit, especially if you are public. You are creating value just by aggregating. So if you are doing 1 to 5 million in profit and want to explore how this can look like for your situation, there is a link below. We are actively executing this strategy at Global Digital Group. Now, everyone is focused on organic growth, which means optimizing the marketing and the sales funnel, improve the product, hire better people, and yes, do all of this by no means. Even if you execute perfectly, it's very rare that you beat growth by acquisitions. One good acquisition or merger can double your business immediately. The mistake is thinking you need to perfect your business before thinking bigger. Hawk shows you can build while you acquire. They went from one asset to 9-figure net worth by using each acquisition to fund the next. So here is your blueprint. First, you need a cash flow. Other existing business or your first acquisition, something generating profit. Second, target fragmented markets. Thousands of small players, no clear winner, that's where the opportunity is. Third, use cash flow and if necessary, some creative deal financing, or at certain scale, once you're a little bit bigger, raising non-dilutive unsecured debt. Don't start there unless you understand how debt works. Then fourth, keep founders involved. This isn't a private equity free or flip model where you strip down the business of the cost and then flip it. You are building a portfolio for decades. And lastly, fifth, build a dedicated M&A team. You can't do deals while running operations. You need focused resources on finding and executing acquisitions. This story basically shows you what happens when you shift from operator to an investor mindset. Going from 3 million to 100 million isn't about working harder on one business. It's about using your existing asset as a platform to acquire other assets. If you already built a profitable business, you are sitting on the foundation for exponential growth. You just need to see the opportunity differently. Whether you want to acquire or want to be acquired, understanding this model changes everything. If you want to explore what this could look like for your specific situation, go to links in the description. We are building this at Global Digital Group right now, my company, and I am happy to share what works for us and what doesn't and share any learnings. See you in the next video.